Okay. So for the gift tax exclusion for the year, it is $15,000, which means on an annual basis, you don't need to file if you give somebody $15,000. Now, what separates the exclusion from the exemption is saying that when it's an exclusion, you don't have to file it at all. IRS, they don't care. When it's an exemption, that means you have to file it, but you don't have to pay. They're not requiring you to pay. They just need you to file it so that they see it. So this $15,000, if you give this to somebody, it's excluded. You don't have to show it up. But once you decide to give $20,000, that means that $5,000 from that 20,000 needs to be filed as an exemption. It's an exemption for it at that point. So you don't need to pay for it. You just file for it. And when you go over, this is the lifetime amount that you can gift without having to pay. So this is the exemption, which is the difference between the two. So for the lifetime exemption, it's saying once you're over that $15,000 per for the year, whatever is left after that, you have to file it to the IRS, but you don't have to pay for it. You're not liable to pay for the taxes that's after it. It's like saying a business exemption. Let's say I tried to include like my car or something and say that it's exempt because I'm using it for my business. This is what the IRS is allowing for you to gift as an exemption within your lifetime. And you can see it right here. It says if you give $15,000 or more to a person in a single year, that you have to file the gift return. It doesn't say you have to pay the tax return, you have to file for it. If it's below the $15,000, you don't need to file for it at all. And just so you could get a bit more reassurance for this, these are .gov websites. These are .gov websites that explains it. And this is pretty much saying what this is saying the same thing I'm saying. E-state and gift taxes are a linked set of federal taxes that apply to transfers of wealth in 2021. E-states face a 40% tax rate on their value above $1.7 million, although various deductions reduce the value subject to the tax. The same threshold, blah, blah, blah. Okay, so that's only saying like if it's above 11.7, there are different things that you can lower the tax value of it, but you still only paid if it's above that 11.7, which it's not. It's not. And even to go, this isn't irs.gov, but if I go to this is a section that's coming from irs.gov. So once I'm gonna go back. This is coming from irs.gov. See irs.gov, and then all I did was go to, I think it was the tax reform, and it takes you to this. And over here, they're going over different examples.